continuing with our discussion of receivables, the second variable consideration that we'll consider is sales returns. Sales returns is where merchandise is returned for a refund or a credit. Special price reduction also might be given, called an allowance, that may be an incentive for a customer to keep the merchandise rather than returning it. Either way, we typically group these as sales returns, and they serve as a form of variable consideration because we don't know if the products are going to be returned, or if it's an allowance, the price is going to be adjusted. So it's variable consideration as it relates to the transaction price. We're not sure what the final amount that the seller is going to be receiving is going to be. If you're logically trying to come up with your own rule, then you could think, well, I basically have two ways I could account for this. Either one, I could accrue the sales returns, meaning I could estimate what the sales returns are going to be in the period of the actual sale, or I could just account for them as they actually occur. Let's see what that might look like. First, let's consider what if we account for them when they actually occur. Consider the example, merchandise is sold to a customer for $10,000 in 2018, and that merchandise costs $6,000. The company would essentially have gross profit here in 2018 of $4,000, the difference between the cost and the actual sales price. But what happens in 2019 if all the merchandise is returned? At that point, if we account for the returns as the returns actually occur, then essentially what happens is that in 2018, our gross profit was overstated by $4,000 because the actual sale didn't take place. Essentially what happens is that the sale we recorded that we thought was going to be fine was returned in a subsequent period as if it never actually happened. So the gross profit was actually overstated in that previous year. And notice that in order to correct it, we have to understate gross profit in 2019. What's more is that assets would actually be overstated in 2018 by $4,000 as well, because you have to consider that we'd probably have an accounts receivable associated with this sale. So accounting for the returns as they actually occur doesn't well represent the transaction that's actually taking place. Therefore, we're required to accrue the sales return at the time of the sale. Now, as a matter of practicality, typically how this gets implemented is that a company will account for the returns as they actually occur, but make an adjusting journal entry to true up the sales returns that are expected at the end of an accounting period. So we'll estimate what we expect the sales returns to be, but then we'll account for the sales returns as they actually happen until we get ready to create financial statements. And then we'll make an adjusting journal entry to increase the amount of sales returns, not just from what they were as they occurred, but to the expected amount that we estimate the sales returns to be. So let's look at an example of how that actually happens. This one says, during 2018, its first years of operations, Hawthorne Manufacturing Company sold merchandise of $2 million. This had a cost of $1.2 million, which was 60% of the selling price. Industry experience indicates that 10% of all sales are going to be returned, which in this case equals $200,000, our $2 million sales price times the 10%. Customers returned $130,000 of the sales during the year, and the Hawthorne uses a perpetual inventory system. Our first journal entry is going to be to record the actual sale. We're going to do this under two sort of scenarios. One is that the sale took place under cash sales. The other one is that it was a credit sale. So here's our standard journal entries that we've already become familiar with. We debit cash, credit sales revenue for the sales price, debit cost of goods sold, and credit inventory for the cost of the inventory. And then if it was under credit, the only difference would be that we have accounts receivable instead of cash. Let's move on to the next sort of transaction. This next one is that sales returns of $130,000 occurred during 2018. So we'll record the sales returns as they occur, but remember, we're not just recording them as they occur, but we're going to true up the estimate as we get ready to prepare financial statements, so at the end of the accounting period. So to record the actual returns as they occur, we'll debit sales returns here. This is a contra revenue account, so it will offset revenue. Okay, for $130,000, credit the cash to pay that amount back, and then we'll reestablish the inventory. The inventory, remember, was 60% of the sales price, and so we'll take the sales price that's returned, multiply by 60%, and that's the amount that we'll debit inventory for, and then credit cost of goods sold, essentially reversing out this previous journal entry. If it was under credit, we'll do something very, very similar. We will debit sales returns here, credit accounts receivable instead, and then debit inventory and credit cost of goods sold. Okay, at the end of 2018, here's where we accrue, which is actually our requirements. So the only reason why we're recording them as they occur is just a matter of practicality. So we can't do that. We already looked at why we couldn't do that. But we can do it as long as we join it with our accrual of the estimated returns that are going to take place. So at the end of 2018, an additional 70,000 of returns is expected. Because remember, over here we said we estimate that it's going to be $200,000 in returns. And so we've already accounted for the $130,000 in returns. So that's where we get the $70,000 in additional returns that ultimately we're truing up the financial statements to represent. They're ultimately representing our estimate, not the actual occurrences. So to record the additional estimate, we debit sales returns, again, that contra revenue account. For $70,000, we credit refund liability, indicating that we expect to pay this back. So we have another obligation here. And then we debit inventory for estimated returns. Now, notice that this is odd because we don't actually have the inventory. This is going to serve as an inventory account, an asset account, but it's going to be tracked separately from other inventory accounts. And this is because it's estimated. We don't actually have possession of the inventory. We just expect that sales returns are going to take place. We do something very similar over here on the credit side, or for the credit sales situation. The only difference that you see is this allowance for sales returns account, which is a contra asset account. And technically, the probably more correct approach theoretically is actually to record a refund liability account. Your textbook has shown various different accounts used over the years, but ASC 606 requires that sellers recognize a refund liability even if the seller has not yet been paid and has a receivable outstanding. And while that may seem odd, the seller is showing a refund liability to cash that is not yet received. Depending on the specifics of the sales contract, some sellers can actually conclude that offsetting the refund liability against the receivable is appropriate, and therefore you have the same sort of impact that you have with allowance for sales returns. So that's why it's sort of shown in two different ways here. Okay, what happens when the goods are actually then returned in the 2019 year, so the subsequent year? Well, then we're going to reverse out our refund liability here. So we'll debit refund liability, we'll credit cash because we're actually returning the cash. We'll debit our actual inventory because we've now actually received the goods back, and remove the inventory estimate that we had previously recorded when we estimated the amount of sales returns. And then we'll reverse out the same journal entries on the credit side too. Remember, if we didn't have this allowance for sales returns, instead it was a refund liability, we'd be debiting refund liability up here as well. Okay, now what happens if we were incorrect in our estimate? So we expected a certain amount to be returned, and it turns out that not all of those actually manifested. Well, in this example, it says, suppose in 2019 that actual returns were only 60,000 instead of the 70,000 that we estimated. We'd still reverse out the journal entries that we had previously estimated. And remember, we're not going to do a retrospective adjustment. Remember, we talked in previous chapters that changes in estimates are handled on a prospective basis. So in the 2019 year, we debit the allowance for sales returns or the refund liability, which we were looking at previously. Okay, and then credit the sales returns to reverse out our previous estimate, and we debit cost of goods sold and credit the inventory on estimated returns, and again, reversing out our previous estimate.